Tariff theater. Why the 7 rally is a mirage, not a market rebound. The recent 7 rally in equities, which happened to coincide with the Trump administration's decision to roll back certain tariffs to 10, has been interpreted by some market participants and analysts as the possible beginning of a broader, more sustained policy shift. This view suggests a potentially softer stance on trade and an easing of global economic tensions. However, a closer inspection of the current situation reveals that the underlying fundamental landscape has not changed in any meaningful or substantive way. In fact, the very superficial nature of the rollback only serves to emphasize how heavily markets have come to rely on appearances, symbolism, and short-term optics, particularly when there is a lack of real progress or tangible improvement. What's more, this rally in equities has not been accompanied or confirmed by any similar move in the bond market. The bond market, often seen as a more sober and forward-looking indicator of economic conditions, has shown no signs of optimism, and its divergence from the stock market underscores the fragility of the equity move. The essential and underlying dynamics of U.S. trade policy, especially when viewed through the lens of global economic relationships, remain adversarial. The conflict between major trading powers is still firmly in place. China, which remains the United States' largest supplier of goods by a considerable margin, continues to face a high degree of sustained tariff exposure. Despite the apparent rollback, the reality on the ground is that the effective rate of tariffs when accounting for multiple prior rounds of tariff escalation and reciprocal responses remains at elevated levels. In several critical categories, particularly those central to manufacturing and industrial production, the total effective rate still exceeds 100. In addition to the ongoing conflict with China, the European Union has shown no indication of easing its stance either. In fact, in several instances, it has instead doubled down and reaffirmed its commitment to retaliatory measures and defensive trade policies. These are not mere temporary disruptions or short-lived policy disagreements. They are the result of deep-rooted, structural conflicts. These conflicts are being driven by profoundly different regulatory frameworks, incompatible economic priorities, and increasingly entrenched protectionist policies on both sides of the Atlantic and Pacific. In response to criticisms and growing concerns, the administration's trade team has attempted to point to a series of limited agreements with smaller economies as signs of progress and momentum in trade diplomacy. However, these so-called victories are, in practice, largely symbolic. They are wins on paper, agreements that may carry diplomatic value or political utility, but they have very little impact on the global economy. They do not materially affect supply chains, alter multinational corporate strategies, or reduce operating burdens for firms with international footprints. For companies that rely on global supply chains or maintain a significant presence in foreign markets, particularly those operating in the manufacturing, technology, and retail sectors, the overall environment remains difficult and constrained. Their cost structures have not returned to pre-conflict levels. Supply chains remain fragile and vulnerable to disruption. The high level of uncertainty surrounding trade policy continues to act as a deterrent to capital investment and long-term planning. Multinational corporations, with Apple serving as a particularly illustrative example, have not experienced any real operational relief. Their upstream suppliers remain embedded within a broader ecosystem still deeply affected by trade restrictions and tariffs. At the same time, downstream demand is increasingly exposed to the effects of price changes brought on by those same tariffs. As a result, profit margins are under pressure. Companies are being forced to adjust and reduce their flexibility. Instead of pursuing innovation and expansion, they are diverting resources to manage risk and hedge against policy volatility. Beneath the surface level indicators, deeper and more structural macroeconomic signals suggest that the environment is not improving but deteriorating. While the unemployment rate remains relatively low by historical standards, recent trends show a slow but steady upward drift. At the same time, real wage growth has lost momentum and has essentially stalled. Inflation, especially in key categories such as services and housing, remains elevated and persistent. This is true even though the headline Consumer Price Index (CPI) may show a decline, creating a misleading impression of improvement. Meanwhile, consumer credit delinquencies are climbing, with more individuals falling behind on payments. These developments point not to a healthy recovery, but to mounting pressure beneath the surface. Moreover, the equity rally is not supported by earnings fundamentals. In fact, quite the opposite is occurring. Forward guidance provided by companies across multiple sectors has been revised downward. Earnings compression is now evident in both nominal and inflation-adjusted terms. This clearly indicates that the source of the rally is not improved performance or stronger financial results. Instead, it is being driven by speculative positioning. Investors are responding to short-term technical signals, not to any long-term change in underlying business conditions. The market is awash in liquidity, and volatility remains elevated. In such an environment, capital is being deployed not on the basis of confidence, but out of necessity, as participants chase momentum rather than data. Adding to the complexity of the situation, current market behavior is starting to resemble conditions seen in the late 1980s. Volatility is no longer limited to isolated events or specific triggers. It has become a persistent feature of the market landscape. The Federal Reserve, for its part, maintains a clearly hawkish posture, signaling that interest rates will remain higher for longer in order to combat inflation. As a result, yields on the long end of the curve continue to rise, creating additional headwinds for equities by compressing valuations and tightening financial conditions throughout the economy. At the same time, growing geopolitical instability is creating a perception shift in the minds of global investors. U.S. assets, which for decades have served as the default destination for safe and productive capital, are no longer seen as impervious to global shocks. Capital that once flowed to the U.S. in search of stability is beginning to hesitate. Foreign capital inflows are slowing. The strength of the U.S. dollar, once a cornerstone of international financial security, is now becoming a liability. A strong dollar reduces the competitiveness of American exports and applies downward pressure to overseas earnings for U.S.-based multinational companies. Within this broader context, the notion that a minor and narrowly targeted tariff rollback represents a meaningful policy breakthrough becomes increasingly difficult to accept. If anything, it underscores how weak and insubstantial the rally's underlying narrative truly is. It highlights the degree to which investors, starved for positive developments, are willing to embrace nearly any headline, no matter how thin or surface level. Until there is a credible and comprehensive de-escalation of trade tensions between the United States and both China and the European Union, until inflation is normalized not just in headline numbers but in core and structural components, until the labor market stabilizes without signs of weakening, and until earnings growth, not speculative flows, becomes the driving force behind market performance, the equities market will remain in a state of structural fragility. This rally, despite its size and visibility, does not signal the start of a recovery. It is not built on solid ground. It is a speculative drift, one propelled more by hope than by hard data, more by appearances than by substance.